So, as Ankit was saying, CorpCare works on the corporate treasury propositions. While I think Mr. Bafna joins, I'll take this opportunity to share some of the research we do on our, mutual fund platforms as well as the bond platforms. So I have my colleague Danesh, who's there in the call. So till Mr. Bafna joins in, he can just share for 5 minutes what we do on mutual fund research. Then my colleague Aman can demonstrate how we manage short-term money for our clients. Also, I have my colleague Jitendra, who assists clients in terms of raising money in terms of structured credit. So maybe we'll shift the presentation since Mr. Bafna is facing some issues. Danesh, why don't you take your 5 minutes and present more on the proposition?
Yeah, sure, sir. Bye.
Perfect.
Thank you, sir.
Thank you,
So what
sir.
I will do, I will just
So
share
what
my
I will
screen
just share my screen
and start
and
the presentation with
start the
respect to
presentation with respect to
the risk reward metrics
the
which we
reward
follow.
metrics we follow.
An- Ankit, we are unable to share the screen. The saying the host isn't allowing sharing for this meeting.
Just a
Ankit,
second, I'm making you host. Now you can, please.
okay.
Yeah,
Thanks,
just a
Ankit.
quick
Thanks. Yeah.
question. What is your ideal customer
So
profile?
what I will do, yeah. So is it my screen visible?
Yes.
Yes.
Yeah. Thank you. So with respect to debt mutual funds and the receiver metrics, what we do, we do the receiver for all the categories of debt mutual funds, starting from liquid, money market, or the short-term, low duration, short-term kind of funds. The basic criteria here is to focus more on risk. Why? Because the clientele which we focus, which we cater is the corporate treasury clients, family office clients. So corporate treasury clients, they are more towards the risk averse. Correct. So they are saying that we just want to focus more towards the risk and the returns come the next part. So with respect to the risk reward methodology which we follow, we have the both quantitative as well as qualitative parameters. Quantitative may we look at the portfolio, its risk associated with the portfolio, performance consistency and so on. And qualitative may we check the AMC pedigree, we check the fund management style, the history of the fund management, the team, there's the risk mitigation process which they follow at the time of selecting some papers or the issuers in the investments. So these are all the risk parameters which we consider, like trade risk, industry risk, interest rate, liquidity, concentration risk, and so on. Performance, there are three basic parameters which we focus, which is YTM, performance, and consistency. So coming to the first category, which is liquid funds. Here, what we do, we have given weightages to all the risk parameters, and we do the scoring of funds on each parameter. Like if in case the first parameter is the trade risk. In trade risk, what we look at both short-term rating and the long-term rating. As you all know, the liquid funds, money market funds, other short-term funds, these fund managers invest the short-term papers which are rated A1 plus. We consider both short-term rating and the long-term rating at the time of analyzing the portfolio. Whether the long-term rating of the issue is a triple A or not, whether it's a double A plus, double A minus, double A, so on and so. If the long-term rating is triple A, then we give high score to the funds. Like for in this case, Mirae as a liquid fund, the credit score is 10, which means the fund manager of the Mirae invests in the CPs and CDs whose short-term ratings are A1 plus, but at the same time, the long term is purely triple A. As compared to the funds which have low score 1 and 2, like Aditya Birla Liquid Fund and Nippon Liquid Fund, which invest in CP CDs whose short-term ratings is A1 plus, but at the same time, the long-term rating could be double A minus as well. So from an issuer point of view, we see some risk involved in these funds. That's why we give low scoring to these funds as compared to the other ones. Coming to the next score, which is the stress sector score and sensitive issuer score, like the fund managers who invest in real estate papers, power sectors, wherein there are some stress involved in that. We give low scoring to these funds. Like in this case, Invesco will be the one, Birla will be the one, and the fund which avoids these sectors are the ones which gets the high scoring, which is the Axis, Mirae, LICs, such funds. So what we do this scoring on each and every parameter. Basis on all the parameters, then we club it and say what is the total risk score, and then we give the rank on basis on the risk. Here, the rank based on the risk means the only risk parameters have been covered. So in this case, the first rank fund is Mirae as a liquid fund, second rank is ICICI liquid fund, third comes your Bandhan liquid fund. Which means if you're a conservative investor, if your investment policy says that you want to invest in the safer papers or safer funds which have only AAA kind of papers, then you can look at these funds like Bandhan, Mirae, ICICI and so. Now coming to the second side of the coin, which is the performance. So we have three basic parameters in the performance. One is YTM. YTM, when we say we check the net YTM of the fund, which is the after your expense ratio. Second is the composite performance. Composite performance may we consider last 1 month, 2 months, 3 months, 6 months kind of returns. And the last and most important is the consistency ratio. Consistency ratio is the ratio which is been calculated basis on last 12 months data. We check on month basis what is the but how many times the fund has outperformed its category. Like in like Axis Fund, whose score is 10, Tata whose score is 9, Birla whose score is 9, which means this fund has outperformed in all 12 months on month basis. Versus the funds like Bandhan Liquid Fund and ICICI Liquid Fund whose score is 2 and 1, which means this fund might have outperformed only once or twice in last 12 months time horizon. So consistency is also one of the important parameter at the time of selecting the funds. So clubbing all these three parameters on returns, YTM, performance, and consistency, we do the ranking basis on the performance only. Like your DSP liquid, access liquid funds are the top ranked funds based on returns and performance. Now clubbing both returns as well as risk, what we do, we come up with the overall scoring of the fund, saying these are the funds which have included both the risk and the reward parameter. Of course, the high weightage is given to risk. Why? Because the clientele which we are focusing is the corporate treasury clients. So the high weightage is given to risk, like 65-70% would be the risk and 35-40% would be the returns parameters. Then calculating all the weightages, we come up with the top ranked funds, which are the DSP, Access, Mirae, Bandhan, and so. Yeah. So we do this analysis for all the funds, all the categories, short-term money market, short duration, corporate bond funds, and such kind of funds. Also, one plans like we do the bucketing also after doing the analysis of the funds. We have three buckets: aggressive, suboptimal, conservative, and premium. Aggressive, the fund which aggressive is the bucket wherein the fund falls in the category which has the high risk and high return parameters, like HDFC, Aditya Birla, Kotak, Utilities, and at the same time they deliver high returns also. The next is this suboptimal, wherein the risk is high and the performance is low. The third is the conservative one, which is the low risk, low return kind of ones like LIC, Tata, Bandhan, and so. And the last and the most important is the premium category, wherein we get the returns also, like Mirae, is ICICI, Nippon, this is kind of the fund on a standard basis. For policy of the corporate treasury, what are the basic filters? How much can be invested in AAA, AA? What would be the AMC level allocation? What would be the category level allocation? Giving the recommendation to our investors. So we do this on fortnightly basis, 15th and 30th, taking the NAVs of 15th and 30th, and then we share the recommendation to our funds. So yeah, this was from my side. Saurabh, you want to add anything?
So, in corporate treasuries, one important piece which our clients, use for the surplus management piece is mutual funds. This is the methodology which we have developed to give our set of recommendations on a consistent basis, thereby optimizing basis both risk and return parameters on fixed income mutual funds. Now, I'll request my colleague Aman, who heads our bond desk, to present certain short-term opportunities and long-term opportunities in terms of how a bond desk can help optimize returns. As I understand, in corporate treasuries, of course, the base is governed by the policies which are written by all the seniors like you who've joined the call. And CorpCare endeavors to work within the framework of the policy parameters and provide solutions to optimize. So, of course, Danish presented the mutual fund solutions. Now, Aman will present solutions on the bond side. Of course, there are corporate treasuries which have, access to certain hybrids or equity mutual funds that possibly Ankit will take a few minutes to present after Aman. And then we'll do a short fund manager call and any questions after that. Aman, over to you.
Hi, thank you, sir. Hi, good afternoon, all. I just put up my screen. So is my screen visible? Hello. Saurabh, is my
Not
screen
really,
visible?
Aman. No. Yeah, now it's visible.
No, it's visible. Okay, perfect. All right. So I'll just go ahead with this. All right. So basically, what we start with is we start with talking about certain advantages that clients have usually when they deal with a bond desk. One of those being that it's a one-stop shop. So if there are clients who are looking for any investments in NCDs, CPs, corporate fixed deposit, or any structured products, we have all sorts of product under one umbrella. Second is a transparent pricing model. Clients do not have to, shell out any extra brokerage transaction or management fee when dealing with CorpCare. Third, usually when clients look at investment opportunity, there is a lot of discussion that happens with experts because there is no in-house product in that sense to kind of push the products to clients. The idea is to give them what is best in their interest, and that's why we prefer having a personalized guidance to every investment that happens through CorpCare. Fourth is all the investments that we do in the bond desk are all exchange based, so there is zero counterparty risk that clients run. And fourth is there is a single KYC documentation which needs to be done, which will suffice across mutual funds and bonds. I'll quickly start with what types of securities do we normally work on. So if you can see on the screen, I'll just try and put a full screen here. So on my screen, if you can see, these are all commercial paper offerings right from 2 months all the way up to 12 months. There are certain names which I would like to highlight. Like for example, if you can see in the 6 month segment, somebody like an Axis Finance or a Julius Baer is offering a very nice spread of around 7 to 7.25 for 6 months. Similarly, if you were to go slightly lower, for 2 months, 3 months, these are the sort of offers that are available. ICICI Kotak at around 640, 650. If you go slightly longer, around 12 months, and if clients are looking at doing CPs, Kotak Mahindra Prime is doing at 705. So there are some very good AAA rated names who are doing CPs in different tenors, right from 2 months to 12 months, where clients can get upwards of 7%. This is one offering that we have. What we've simply done here is we've made a comparison between a client who's invested in liquid funds if they were to make a portfolio of CPs and invest in it. So this is a simple comparison of a liquid fund portfolio at 6%. And vis-a-vis what we've done is we've prepared a CP portfolio which is yielding around 7 quarter. So these are the sort of spreads of almost 125 to 150 that can be created by only investing in CP. Yeah, this is a similar exercise that we've done for 6 months. Here we've been able to create a spread of around 90 basis points. What we also have here is we have certain short-term bond codes The idea here is, in case if there are very specific requirements on having investments only in secured NCDs, what we've done is we've collated all AAA, AA minus maximum. So if you can see, there are likes of Tata Capital, State Bank of India, Shriram, which are available at very good spreads. Like State Bank of India, September 26, this 6 months paper is available at 7 quarter. Again, if clients are slightly willing to go beyond AAA, then there is Piramal, which is at 810 for around 1 year maturity. So some very interesting offers in short-term bond quotes. Similarly, we also deal in right from AAA rated. So if you can see on the screen, these are some AAA rated offers from AAA, AA to AA plus, and also for AA minus. What I'll also like to show once is also an advanced tax offering which we have for clients. This is might also be of interest. What we've done is, this is specifically the deck for short-term specific. So there is one product which we've been asking our clients to look at, which is basically for an advanced tax whenever there is a requirement from a client. What we've done is we've taken the advanced tax dates for every quarter. Let's say this is for March, June, September, and December. These are broadly the dates for the advanced tax payment. What we've done is, for these specific dates, we have taken out opportunities in every product. For example, if you're looking at CPs and if you're looking at AAA, if you're looking at AA plus, or you're okay with AA, we've given offers across rating from AAA to AA for CPs. Similarly, we've also given opportunities in fixed deposits, same as with mutual funds and NCDs. So we've done this exercise for March, June, September, and December. So if any client is looking for a specific investment to meet the advanced tax payment, this can really help in terms of getting a broad idea for different yields which are available for different sort of products, right from CPs, NCDs, mutual funds, and NCDs. So this is on that. There is another offering that we have. So what you can see on the screen, these are all intramonth offers. This is right from 7 days, 8 days, and goes all the way up to 30 days. So these are the sort of offerings that we have on.
Sure. So thanks, Aman. Thank you for showing these opportunities. I think we have Mr. Basant Bafna, who's the CIO at Fixed Income Head for Mirae Mutual Fund, who's also graced us on this occasion. Akash.
Yes, Saurabh.
Yeah, hi. Hi, Basant. So thank you for your time, and I know you're facing some tech challenges joining, but thanks for making it. So, I'll also use this opportunity, ladies and gentlemen, to, pick on, leveraging on Basant's extensive experience being the CIO of one of the largest funds in India, as well as, a seasoned banker spending almost close to 15 years with Exim Bank, working across Treasury, dealing room, and fixed income instruments. So thanks, Basant. Now, with your permission, maybe I'll ask, seek your views on certain, questions. Is that fine? Should we go ahead?
Sure.
Sure. Am I audible, Basant?
Yes.
Perfect. So, Basant, see, what we've seen is that, RBI has cut rates almost 125 basis points, but there has been very little transmission of yields to the investors, to the corporates, as we move forward. In fact, longer tenure yields have moved up, although RBI has cut rates. What do you see the forecast in terms of yields as we move into 26? And what are the cues which we can take from here on?
So the movement in yields. Sorry, my voice is. Hello. Yeah, perfect. See, what's effectively happened over the last quarter or so is that while rate cuts have happened, a large part of transmission in the debt capital markets have not happened. But if you look at the banking side, because a large part of the banking loans are linked to external benchmarks, either a repo rate or a T-bill, MCLR linked loans, the transmission has been slower. But on the other segment of loans, the transmission has been quite fast because it's linked to external benchmarks. External benchmarks clearly track the RBI repo rate. So treasury bills in general, repo rates, of course, once a rate cut happens, then loans start, which are tracking the repo rate, start falling. So all of that has happened. And because of that, what has happened is that the key movement from corporates and a large part of bankable on the market side, NBFCs, they have actually moved from the markets towards banks. And because that has happened, that has put a pressure on the CD ratios of banks. While bank deposit rates have remained attractive on a absolute basis, so close to 100 basis points over and above repo rates. Generally, the top 5 banks on the private sector space as well as the public sector space are offering close to 100 basis points above the repo rate. But because the gap in terms of the deposits and credit has grown massively, which has been amplified by way of shift of these corporates towards banks due to better transmission over there, yields have sort of remain anchored, because banks on one hand they've been using their excess SLR to fund these credit growth. And for a lot of these banks, if you look at the top 5, say private sector banks as well as public sector banks, they are operating at over capacity right now. So if you look at the statutory requirements, so you have an 18% requirement of SLR, you have a 3% requirement of CRR. So effectively, you can lend close to 79% of the overall NDTL, or maybe in a crude language, deposits that you can garner. Now, these banks have been operating over the last quarter at 125% north. So what has happened is that while RBI has been very consistent in infusing durable liquidity for banks by way of OMOs, but with OMOs, initially banks were dipping into excess SLR, so they were offering the securities to RBI, and the liquidity such created was being used to fund credit growth. But over a period of time, a large part of excess SLR dipping has already happened. And recently, what we've seen is that banks are actually using this opportunity to tender the illiquid securities to RBI and buying back liquid securities on screen. So because of that, the amount that is available for credit growth because of the excess dipping of SLR has just not been there. The second key factor because of which the shorter end of the curve has massively sold off is that a large part of liquidity goes out of the system generally towards the quarter end and then comes back at the beginning of the quarter. This time that has not happened. So at the beginning of the quarter, you've not seen liquidity increase into the mutual fund industry. And large part of money market instruments are generally funded by the mutual fund industry. And primarily because of high CD ratios, that has got amplified by the fact that supply has been very consistent. So just to give you a reference in terms of overall numbers, over the last 10 days or so, we've seen a 1-year CD supply of close to 30,000 crores. So because of that, what has happened is that generally when such supply comes, it comes at the expense of the shorter end of the curve, and shorter end of the curve gets absorbs all of this because you get massive flows at the beginning of the quarter. But since this has not happened, the curve has actually undertaken a steep shift. So while the shorter end of the curve has moved significantly because the absorption is now dependent on banks who themselves are under pressure, longer end of the curve has moved higher because of the limited appetite to support that, and that has been by way of selling of the shorter end of the curve. So because of this phenomenon,
yeah, go ahead.
Been a massive sell-off in terms of the rates in the shorter end. And in the longer end, what has happened in terms of the corporate bond spreads, there generally what happens is and this is the phenomenon that has started post policy itself, is that generally, when you are at a crossroads of a policy wherein the expectations of a rate cut is significantly high, then you sort of beef up your duration, go fully deployed into the policy, and then once policy is in line with expectations, you expect the trading community, majorly banks, primary dealers, and so on and so forth, they sort of come in and build that sort of demand to bring the yields downwards, and then at that point of time you get a lot of opportunity as asset managers to realign portfolios. But this time, what has happened is that because of high CD ratios, the trading community has actually been virtually absent, and therefore yields have consistently moved ahead upwards. Now, does this mean that this segment is not attractive yet? No, I mean, this segment is extremely attractive as compared to historical trends. If you look at 3-year corporate bond spreads, or say 5-year corporate bond spreads, they are at least 40 to 50 basis points higher as compared to 3-year averages. So from that perspective, the curve looks extremely attractive, but will the pressure persist this quarter? Perhaps yes. But over the medium term, when you're looking at advising your clients, does this look extremely attractive as a fixed income proposition? Perhaps yes.
So, Basant, the question is, what percentage of clients' portfolio should be on the longer end, say greater than 5-year or 10-year gilt funds or dynamic bond funds, as the case may be? Because you said that the spreads are very attractive. Is that the risk reward in that segment is favorable at this point?
See, if you look at the sovereign segment, as compared to historical averages, it's still higher. So if you look at the last 10-year average of repo versus 10-year sovereign yields, it's closer to 100 basis points. We are now trading at, I think, north of 135 basis points, right? So from that perspective, maybe perhaps 140 basis points. So from that perspective, the scope of, if mean reversion happens, is significant. But the major challenge is that there has been a shift in the overall government finances between center and states, in the sense that center has been able to manage their finances really well. But states, from a state's offering, their supply has massively increased because all the incremental measures that are being taken, 70% of that impacts states, and therefore there has been a dramatic increase in the state borrowing. And add to that, what has happened is that for a lot of long only entities, the allocation for equity in their overall corpus has increased. Because that has happened, a large part of overall flows actually have moved towards equity than debt, and longer end of part of the curve is generally anchored by the long only segment, so insurance, PFs, pension funds, and so on and so forth. Now, because the demand has been virtually non-existent, you are then dependent on banks for supporting that segment, and because of change in regulation since April, you actually cannot park significant amount of these securities which have been purchased in their HTM books, because then after that you are not allowed to move that security into your trading book and sell beyond 5% of your overall size. So from that perspective, there has been very limited demand by banking community, and therefore the spreads have started widening. A large part of the demand that is accruing from the banking community is in the 3 to 5 year segment, or switch in the securities from illiquid 8 to 12 year bucket to the 10-year liquid sort of bucket. Now, in terms of attractiveness of the segment, so if you look at it from a long investment horizon perspective, from a retail investor's perspective, so you look at the long duration category, so 30-year, 40-year gilts with inflation remaining steady at close to 4%. And if you look at the historical trends, 2 decades back, we were a double-digit inflation economy. Last decade, we've been a high single-digit sort of economy. This decade, we are closer to the 5% sort of band economy. So as economy grows, the overall inflation with an excellent track record of the central bank in terms of managing inflation is bound to gradually reduce. And with that as the background, with longer end trading at close to 7.5%, 7.45, 7.5 sort of band, which is semi-annual, so annualized basis close to 765. I mean, a risk-free instrument with 3.5% plus beating inflation. I don't think there is any other instrument in the fixed income space that beats inflation so well. But in the short term, perhaps to the medium term, is there volatility expected? Yes, volatility is bound to be expected. But if you want to beat inflation from a long-term investment horizon perspective, it still is an excellent product to sort of look at. Sorry, you're on mute.
Thanks, Hassan. Yeah. So, one question for you with the, current account deficit being in manageable limits at 1%, supported by, strong service exports and lower crude price. What do you think, is the forecast on currency? The dollar has been consistently breaching 90 and going above this. So, your thoughts in 26 on dollar INR?
See, in terms of so while we are not experts on currency, but the approach which I have seen over years of the central bank is not to control a level of the currency. I think markets also in general, with a steady 2 to 2.5% sort of depreciation of currency, are comfortable, and which is then accounted for in margins of the exporting as well as importing community. The only thing is that when there are abrupt movements of currency, like we saw 3 weeks back, that point of time, you have a significant impact on importers. And like you alluded to in your initial comment, we are essentially an under-hedged economy with a current account deficit, right? So from that perspective, a sudden and abrupt movement in terms of currency impacts importers significantly. From that perspective, the motive of RBI has always been to ensure that the currency does not slip at an abrupt pace. I don't think the intention is for the currency to sort of hold at a particular level. And by way of historical patterns, I mean, RBI has used up a large part of their buffer in terms of forex reserves for interventions over the last 8 weeks, 8 to 10 weeks. So if you see flows kicking in, either by way of FPI flows into equity or debt, the index inclusion, I think, has got deferred till the mid of the year. But as and when you see those sort of flows kick in, the base case expectation is not for a runaway appreciation of the currency. I think the central bank would use those flows to sort of build up buffers back to higher levels in case we start seeing such sort of volatility bouts again. Because at the end of the day, we are in a highly sensitive geopolitical era. And from that background, some headlines can always cause disruption in terms of the movement of currency. And that's the whole sort of aim of the RBI, that in case there is some abrupt movement in terms of currency, which is not justified by fundamentals, you try and sort of intervene to make sure that the overall movement is smoothened. I don't think it's a control on the direction. It's perhaps control on the volatility.
Thanks. Thanks, Basant, for that. Another question to you would be, recent speech, the RBI governor said that lower inflation, I mean, the last few quarters or months have been under 2%. And the GDP forecast being almost from 6.8 to 7.3%. He referred to India being in a Goldilocks kind of a scenario. And what do you see in terms of 2026? Will this GDP growth ratio and the lower inflation spur the industrial production spending coupled with GST cuts? How do you see 2026 planning for in this scenario?
So in terms of see, when you look at the overall landscape, while inflation is anchored closer to 2% now and for the year as well, but because of this, it creates a lower base effect going into the next year. And broadly, I mean, inflation is expected to be anchored closer to 4% for the next year. Of course, you have the new CPI series, which is expected next month. In case, because consumption patterns have sort of changed over the last 15 years. Food as a percentage of overall consumption basket has fallen. So that is expected to bring down inflation a bit. But if that is significant, then that opens up a bit of scope or space for further action. But the base case remains that you remain at a status quo in terms of policy rates over the next 12 months as inflation remains anchored to 4%. Core also, for that matter, is not expected to go massively higher, primarily because the GST cuts have given tailwinds of 30 to 40 basis points. Now, in that background, while GDP is expected to remain in the range of 6.5 to 7.5%, but capacity utilizations have still not crossed 80%. Now, till the time capacity utilizations don't exceed 80%, you will not see new fresh capex come into the system. In terms of overall consumption patterns, I think we've seen consumer discretionary spending being strong, expected to remain strong as our middle class grows. But the essentials, there is no runaway growth in terms of the essentials. So in terms of the factors driving growth for the next year, we believe that one is consumer discretionary sort of segment driving growth going forward, but government will continue to have to do a bit of heavy lifting for a large part of next year as well, and fiscal space remains for them to do so. Till the time you start seeing transmission effects moving into the real economy, because clear transmission effects have still not moved into the real economy, and that sort of spurs demand, which in turn spurs capacity utilizations beyond 80%, and then you start seeing fresh capex kick in. So it's a 2 to 4 quarter story. I don't think it's an immediate story in terms of growth getting a massive amount of boost. But yes, you will see some signs out of these going into the next year, and that's where you will start building up positions from there.
Perfect. So thanks, Basant. I think thank you for your time. Really incisive information which we can use from a client's perspective. Thank you so much. Now I'll just Ankit, would you want to share some amount of strategies on the hybrid and equities and SIFs quickly with the clients before we conclude the call?
Sure, sir.
With your permission, Mr. Saurabh, can I log out?
Thank you, Mr. Basant. Thank you so much.
Thank you for it.
Okay, so these are the few equity options that we do, equity PMSs and AIF that we recommend. So this model is based on the qualitative and quantitative parameters. So by qualitative parameters, I mean things like the ideology of the fund or the experience of the fund manager, the team size, so on and so forth. That comes under the qualitative aspect. In quantitative aspect, we cover the portfolio management services risk and reward matrix. So there are risk parameters, there are return parameters, and with the help of this, we create a risk and reward matrix. So you can see that we have ranked the funds through the risk parameters. So Samiksha is coming as first in the risk parameter. So and return parameter, you can see Stallion is coming as first, but on an overall basis, Bond is coming first. So this is purely quantitative and not as per any preference or any external intelligence. So this is the pure risk reward matrix through which we recommend the AIFs that we do. Coming on to the ETFs and index fund, so some of the benefits like liquidity, tax efficiency, liquidity, low expense ratio is what we get in the ETF and index fund, where we make two portfolios: a diversified conservative portfolio and an aggressive portfolio. These are a mixture of 7 stocks or index funds that we recommend every month. It changes every month depending upon the market scenario. Again, qualitative and quantitative parameters is what we take. Things like Nifty Next, small cap, banking sector, where we see value index. In strategy, we see Nifty 200 Alpha 30 and a commodity silver. As you know, silver has done good. So these are the mixture of ETFs and index funds. That's what we recommend, because ultimately it is said that a fund manager cannot beat the market consistently, but in the long run, the passive is said to prevail. Also, there is a new category called specialized investment scheme, which is more than equity and less than PMS in terms of regulatory oversight, in terms of performance. So there are two specific funds that we recommend. The first would be Altiva, second would be SBI Magnum. So Edelweiss, the return would be anywhere between arbitrage plus 3. So post tax, post fees, 11% fix is what we get. Similarly, Magnum SBI is more towards conservative side where they're giving fixed 8%. So this is a new category, specialized investment scheme with minimum ticket size of 10 lakhs is what we recommend to the family offices and the corporate treasuries where people are making amendments. Coming on to the portion where we gradually increase the equity exposure, wherein corporate treasuries and family offices are taking exposure. So right from arbitrage fund where we have long short, so a zero kind of equity exposure, to increasing equity exposure in equity savings funds where we have 20-40% of equity exposure, to balance advantage where we have 40 to 60 kind of equity exposure. So this is the entire gamut of the equity portfolio, equity exposure that we manage for the family offices in the corporate treasury. Obviously, the family offices have more affinity or more they have more dedication towards the equity side of the exposure in the market. So yeah.
Thanks, Ankit. So just as by way of CorpCare also assists corporates in raising funds. If somebody is desirous of raising debt or equity on an overall basis, we worked with our clients extensively in providing growth capital and assisted them across geographies. We are present in Delhi, Bombay, Bangalore, Chennai, Indore, Ahmedabad. These are the places where we have physical presence. And should you think we could assist you, our teams would be very happy to get in touch with you and provide our solutions, both on the surplus management side as well as the family office side. We thank everyone for taking out the valuable time on a Saturday evening. Happy to take any questions, or address any queries which we have at this stage. And like one of the seniors on the call mentioned, we'll ensure our presentations and the recording of this call is sent to all the participants with the link for their consideration.
Sir, I have a question. Right now, we spoke of various options in case we have surplus funds. But do we have any proposition with foreign currency exposure to mitigate currency exchange risk? Because there will be many exporters in the defense manufacturing sector.
Thank you, ma'am, for the question. Yeah, thank you for the question, ma'am. Yes, we assist our clients in managing surpluses both in India and outside India, in optimizing and providing solutions, both placing in like instruments like bonds, mutual funds, ETFs, like we do in India. I hope I answered your question, ma'am.
Yeah, thank you very much.
Thank you. If there are no more questions, I'd like to conclude the call. Thank you so much for your time. Really, it's really kind of you to spare time on a Friday evening for a session. And also thank Mr. Basant Bafna from Mirae, who joined us and shares his views on an overall basis. So thank you. And we'll be happy to assist you in your surplus management journeys or borrowing or growth capital. Happy to assist you as well.
Just one quick question. Can I ask?
Yes, please, sir.
What is the minimum surplus where your service start?
So, sir, since we deal on a B2B basis with corporates and we try to provide a 360-degree solution, I don't think of any minimum surpluses, which we ask our corporates. But as Aman explained in the bond deck and all, there is market lots which are starting from 5 to 10 crores if one were to buy bonds, because that's the market lots which you can trade at. But simpler instruments like mutual funds, SIFs, and all, those are pretty agnostic as far as ticket sizes are concerned from corporates, both on surplus management or as well as landing. Because we are on B2B, we look at assisting clients and not keep any minimum ticket size. Our largest clients, we manage 3,000 crores of surplus, and our largest lending, we did 800 crores of lending transaction. Though the team is geared to handle clients, because we believe our clients will grow bigger, larger, and 1, 2, 3 crores will soon become 100, 200, 300 crores, and we'll grow with them in that sense.
Got it. Thank you. Thank you.
Perfect. Thank you so much for the question, sir. Any more questions, or we can conclude? Perfect. Thank you, ladies and gentlemen, for joining. Really appreciate your time. Do have a super weekend ahead. Thank you so much.